There's a pattern hidden in the history of capital markets that has destroyed more wealth than all wars combined. It's the moment when the market's walking dead, the so-called zombie companies, finally fall over, taking the $10 trillion corporate junk debt market with them. This isn't just a correction. It's the purge that was delayed, the necessary, violent winter of the economic cycle, and it's coming to a head in 2026. The crisis of 2008 was a crisis of housing and banking leverage. The crisis of 2026 will be a crisis of corporate solvency and systemic credit collapse, far more diffuse and ultimately more devastating to the productive economy. This is the collapse of the everything bubble, and it's being driven by a mathematical impossibility. Companies that cannot afford to pay the interest on their debt, yet have been kept alive by 15 years of subsidized credit. The patterns are all aligning right now. The Kondratiev wave, the debt supercycle, the generational cycle, they all point to the window between 2025 and 2027. And the most dangerous fuse, the one that will ignite the whole system, is the zombie junk debt bomb. This is the story of how the Walking Dead took over the economy, why they are the key to the coming financial winter, and why, when they finally default, it will unleash a crisis that makes 2008 look like a warm-up. The anatomy of the everything bubble, the delayed winter, 2,000 words. The economic cycle is governed by forces far larger than any central banker or politician. The Russian economist Nikolai Kondratiev documented this long wave, a roughly 50 to 60-year cycle moving through 4 distinct phases: spring, growth; summer, peak; autumn, stagnation; and winter, collapse. The last full Kondratiev winter, the one that purged the excesses of the 1920s, was the Great Depression of the 1930s. The next winter should have arrived in 2008. The collapse of Lehman Brothers and the global credit freeze was the crack in the foundation, the signal that the system had reached peak debt saturation. But that winter was delayed, not canceled. Governments and central banks panicked. They didn't allow the system to cleanse itself. Instead, they pumped in trillions of dollars through quantitative easing, QE, and held interest rates at zero for over a decade. This was the great anomaly of modern economic history, a forced 15-year extension of the autumn phase. The consequence of this unprecedented intervention was the everything bubble. Normally, in a cycle, one asset class, like housing in 2008 or tech stocks in 2000, inflates. But from 2009 to 2022, every single asset inflated simultaneously. Stocks, bonds, housing, commodities, and yes, corporate debt. The entire world, starved for any yield above zero, piled into the riskiest assets they could find. The debt tsunami, a false feast. The corporate bond market became the primary recipient of this liquidity. Companies, from the highest-rated blue chips to the smallest, riskiest startups, borrowed money at rates that were effectively a gift. This wasn't because their balance sheets were strong, it was because the Federal Reserve had destroyed the price of money. U.S. corporate debt. Outstanding. The sheer volume is staggering. The U.S. corporate bond market now exceeds $11 trillion in outstanding debt. Globally, the corporate bond market is massive. The race to the bottom, BBB, the lowest rung of the investment grade ladder, BBB-rated bonds, exploded. The total value of BBB debt grew to represent over 50% of the entire investment grade market. This is the most precarious form of safe debt. A tiny slip, a minor economic contraction, and these massive pools of debt immediately turn into junk. The fallen angels. The term for bonds downgraded from investment grade, BBB, to junk status, BB or lower, is fallen angels. This is the leading indicator of a credit crisis. In 2025, downgrades have surged to a decade high, signaling rising credit stress. This cheap money created an economic environment of false profits and subsidized survival. Instead of productive companies emerging, the system was flooded with zombie companies. The Walking Dead, zombie companies explained. The term zombie company was coined in the 1980s, but the phenomenon has never been as widespread as it is today. A zombie company is an entity that is dead but still walking. A zombie company is defined as a business that can only generate enough revenue to cover the interest on its debt, but cannot afford to pay down the principal, nor can it invest in growth, innovation, or profitability. Its interest coverage ratio, ICR, is below 1 for 3 consecutive years. Why do they exist? Because low interest rates allow them to refinance their debt repeatedly. When the old loan comes due, they simply take out a new, equally cheap loan to pay off the interest, living in a perpetual debt-fueled survival mode. They are kept alive not by their business model, but by the subsidized credit of the central bank. This is economically catastrophic because zombie companies are a cancer on the productive economy. Misallocation of capital. They hoard capital, preventing it from flowing to younger, more productive, and innovative companies. Distortion of competition. They sell products below the cost that a healthy company burdened by real debt service would have to charge. They drag down healthy competitors. Stagnation, they don't invest in physical or intangible capital, R&D training. They are static entities waiting for death while sucking the life out of their industries. In the past 15 years, the population of zombie companies has exploded across sectors most reliant on cheap financing, including real estate, retail, business services, and high-tech industries. They are the weakest link in the everything bubble, and their failure will be the domino that topples the entire corporate credit tower. 2. The alignment of the death cycles, pinpointing 2026. The coming crisis isn't a random event. It's the inevitable culmination of intersecting, predictable cycles. The precision is terrifying, yet most people remain unaware. The key is to look not at a single indicator, but at the convergence of three major forces, all pointing to the same small window. 2026. 1. The Kondratiev winter's delayed arrival. The long wave. The Kondratiev wave, as established, dictates the overall rhythm. The winter phase, the period of destructive deleveraging, was postponed in 2008. The true winter, a true K-wave. Winter must purge the two key excesses of the preceding autumn, debt and overcapacity. The 15-year extension of the autumn phase has only made these problems exponentially worse. The collapse of the zombie companies is the mechanism by which the overcapacity, factories, stores, real estate, and debt will finally be destroyed. The 2026 flashpoint. Based on the typical length of a full cycle and the timing of the previous major crisis, 1929-1933, the system is due for a violent reset between 2025 and 2030. 2. The yield curve's uninversion signal, the short-term clock. This is the most reliable financial indicator of a recession, and its signal is ticking down right now. The inversion. The yield curve inverts when short-term interest rates are higher than long-term rates. This has preceded every U.S. recession since 1950 with no false positives. Why? Because it reflects the bond market OS expectation that the Federal Reserve will soon be forced to aggressively cut rates to save an imploding economy. The yield curve was inverted for a prolonged period, one of the longest in history. The uninversion. The recession typically doesn't begin until after the curve uninverts, snaps back to normal, as long-term rates fall faster than short-term rates. The uninversion is the final warning shot. Once the curve normalizes, the historical clock starts ticking. History shows recessions typically begin 6 to 18 months after the UN inversion. Given the timing of the curve's normalization in 2024-2025, this places the recession's onset squarely in late 2025 to mid-2026. 3. The corporate debt wall, the refinancing crisis. This is the specific event that will merge the delayed Kondratiev winter with the yield curve's ticking clock. The mass refinancing of zombie junk debt is a mathematically guaranteed flashpoint. The low-rate trap. For 15 years, corporations issued bonds at rock-bottom rates, e.g. 3 and 4%. These bonds have maturities that are now coming due en masse. The high-rate reality? When these debt loads mature in 2025 and 2026, companies face a catastrophic new reality. Interest rates are no longer 3%, but 6% to 9% or higher. The typical yield on corporate bonds is above 6% in 2025. The tipping point. For the zombie companies, those barely covering 3% interest with their operating profit, refinancing at 8% is simply impossible. Their cash flow will not support the new debt service. They cannot roll over the debt, and they cannot pay the principal. The default is forced and inevitable. The heaviest concentration of these refinancing deadlines, the maturity wall, hits precisely in 2020 to 2027. This timeline ensures that the wave of forced defaults will cascade directly through the yield curve's recession window. The convergence of these cycles is a certainty. The Kondratiev winter is the destiny, the yield curve is the clock, and the zombie debt wall is the trigger. 3. The zombie junk debt bomb. Mechanics of collapse, 2,000 words. The collapse will be initiated not by a Lehman-style bank failure, but by a wave of corporate bankruptcies spreading like an epidemic through the junk bond market. The sheer size and fragility of the high-yield bond market makes it the financial system's central point of failure. The $10 trillion target, junk bond exposure. The U.S. high-yield, or junk, bond market is massive. These are bonds rated BB or lower, issued by companies with the weakest credit profiles, the kind of companies that become zombies. The quality slide. Driven by low interest rates, investors accepted less compensation for greater risk. The covenant quality, the protections built into the bonds for investors, has plummeted to historic lows. Investors lent money with fewer guarantees than ever before. The default cascade. When the refinancing wall hits the zombie companies in 2026, the default rate will spike. In the 2008 crisis, the high-yield default rate peaked at 13.7%. This time, the default rate for leveraged loans and junk bonds could easily exceed those levels due to the greater number of existing zombies and the sheer increase in interest costs. The downgrade doom loop, the wave of fallen angels, bonds falling from investment grade, BBB, to junk, will compound the crisis. Forced selling. Many large funds, pension funds, insurance companies, are legally restricted from holding junk bonds. As an investment-grade bond is downgraded to junk, they are forced to sell immediately, regardless of price. Price collapse. This mass forced selling floods the junk bond market, causing a price collapse across the entire sector. Even healthy junk bonds see their prices crater. Credit freeze. The collapse in bond prices makes it impossibly expensive for any company, healthy or zombie, to issue new debt. The credit market, the lifeblood of capitalism, freezes instantly. The shadow banking black hole. Private credit. Adding fuel to this fire is the rise of private credit. Since 2008, the private credit market, lending done outside of traditional banks, often by private equity funds and asset managers, has exploded to become a $1.5 trillion shadow banking system. The regulatory gap. This debt is entirely unregulated and untransparent. There are no public ratings, no liquidity requirements, and no safety nets like the FDIC. The zombie shelter. Private credit funds became the preferred financiers of zombie companies after banks pulled back. They offer bespoke, often highly complicated and highly risky loans. The great pretending. Unlike public markets, private credit firms have an incentive to pretend their loans are fine for as long as possible. They can extend and pretend, refinancing the debt again and again to avoid marking losses on their books. This delay makes the inevitable crash far worse. When these loans finally go bad, the losses will hit pension funds and insurance companies that invested heavily in private credit funds, creating a deep, opaque black hole of loss that will shock the financial system. The productive economy implosion. The collapse of the junk debt bomb will instantly transition the economy from a slow, grinding recession into a full-blown K-wave winter. Mass corporate bankruptcy. Zombie companies are liquidated. Their assets, real estate, machinery, inventory, are dumped onto the market, driving prices down across the board. Deflationary shock. Millions of jobs are lost. Investment strike. Healthy companies that survive cannot access financing. They stop all investment in R&D, new facilities, and hiring. Economic growth instantly vanishes. Financial contagion. The losses wipe out the balance sheets of asset managers, private equity funds, and most importantly, insurance companies and retirement funds that held the toxic bonds. The crisis shifts from the corporate sector back to the financial sector. The great pretending will end with the great purge of the corporate dead. IV. The great divergence. Winners and losers. Of the purge. Every crisis is fundamentally a massive, non-violent transfer of wealth. The collapse of the everything bubble will be no different. The key distinction this time is the magnitude of the transfer, largely due to the scale of the zombie company purge. The transfer will be from the unproductive, over-leveraged middle of the economy, the zombie companies, the low-rated bondholders, the pension funds, to the cash-rich extremes of the elite, and those positioned in essential assets. The losers, the everything bubble victims. The losers will be the ordinary savers, workers, and investors who trusted the illusion of stability created by the Fed's QE policies. The middle-class saver and retiree. Their losses will come primarily through pension funds and 401ks. Pension funds have chased yield by investing heavily in the fallen angel bonds and the opaque world of private credit. When those assets go to zero, the funds will face multi-trillion-dollar holes. This will lead to a political crisis over retirement security, forcing governments to choose between massive taxpayer bailouts or significant reductions in benefits. The zombie workforce. Millions of workers employed by companies that shouldn't exist will be instantly unemployed. Unlike 2008, which centered on construction and finance, this crisis hits retail, business services, media, and tech, the heart of the modern service economy. Unemployment will spike rapidly. The regional banks, round two. After surviving the commercial real estate CRE scare of 2023, regional banks are not out of the woods. The corporate debt crisis and the ensuing recession will cause a massive rise in commercial and industrial C&I loan defaults and a second, larger wave of CRE defaults, forcing many regional banks into the FDIC's resolution authority. The winners, the cash kings. The winners are not those who are clever, but those who are patient and liquid. They are positioned to deploy capital at the moment of maximum panic, buying up the liquidated assets of the zombie companies at fire sale prices. The private equity elite, the vultures, they have spent years raising a dry powder, massive war chests of cash totaling hundreds of billions, held precisely for the moment of crisis. As zombie companies file for bankruptcy, private equity firms swoop in to acquire their assets, factories, intellectual property, real estate, for pennies on the dollar. They are the liquidators of the K-wave winter, buying the productive capacity of America at the cheapest valuations of the century. The hard asset holders, those who saw the debasement coming and positioned their wealth outside the paper economy, will preserve their purchasing power. Physical gold and silver, the ultimate currency collapse insurance, productive agricultural land, real value that produces food, essential for any economy. Self-custodied Bitcoin, the digital store of value that cannot be seized or bailed in, riding the inevitable flight from fiat currency. The technology innovators, the next spring, the K-wave winter purges the old and makes way for the new. The next spring, the new growth cycle, driven by technologies like AI, biotech, and new energy, will be built by companies that were prudent during the bubble. They will now have cheap capital, cheap assets, and no competition from the walking dead. They are the seeds of the next boom. The great wealth transfer is fundamentally a transfer from debt-based, unproductive assets to cash-based, productive assets. The lesson remains. When the music stops, cash is not trash, it is king, and the ability to buy cheap assets is the ultimate key to generational wealth. V, the final warning, the path to survival. The K-wave winter is not a possibility. It is a mathematical certainty written in the converging cycles of debt, interest rates, and corporate insolvency. The zombie junk debt bomb is armed, and its fuse is ticking down to the 2026 maturity wall. This is the last window of opportunity to prepare for the violent purge that the government postponed in 2008. The contagion sequence, what to watch. For the collapse will be a sequential, predictable process. You will not get a clean warning. You must watch for the accelerating indicators. The fallen angels spike, already happening in 2025. Look for the acceleration of downgrades from BBB to junk, BB. When the downgrade volume doubles or triples from the 2025 level, it means the dam is breaking. Commercial real estate, CRE, bank failures. The first dominoes will be regional banks with outsized exposure to CRE loans. The FDIC will try to contain it, but the headlines of bank failures will create an instant panic that dries up corporate lending. The liquidity freeze, the cost of buying insurance against corporate defaults, measured by the credit default swap, CDS index, will spike to crisis levels. This is the moment the credit market is officially frozen. Even healthy companies can no longer roll over short-term debt. The corporate bankruptcy wave, the 2026 purge, this is the climax. Watch for simultaneous, high-profile defaults across several different sectors, retail, media, services, and tech, that were previously considered safe or too big to fail. This is the system destroying the walking dead. The 3 pillars of protection, your action plan. Survival in the K-wave winter is not about predicting the exact date. It's about maximizing liquidity and positioning in non-paper assets. Shed the anchor, debt liquidation. Pay down all consumer debt. Credit cards and personal loans become an existential threat when income is uncertain and interest rates are high. Debt is an anchor that forces you to sell assets at the bottom. Reevaluate mortgages. A low fixed-rate mortgage is a good asset in a currency devaluation environment. Inflation reduces the real value of the debt, but any high interest or adjustable rate corporate or consumer debt must be eliminated. Maximize your lifeboat, liquidity. Build massive cash reserves. The ability to deploy capital at the moment of maximum fear is the key to generational wealth. Keep 12 to 24 months of expenses in cash or ultra short-term 3-month treasury bills. The slight loss to inflation is cheap insurance against a 50% market collapse. Diversify FDIC coverage. Do not hold more than $250,000 at any single banking institution. The next crisis will see the FDIC invoke resolution authority, and only insured deposits will be immediately accessible. Position for the new spring, hard assets, physical gold and silver. Move a significant portion of your capital into physical precious metals held outside the banking system. They are the ultimate store of value during a financial reset. Bitcoin, self-custody. Own a small, non-zero allocation to Bitcoin, held in a hardware wallet you control. This removes your digital asset from the jurisdiction of a potential bank bail-in and government seizure, positioning it for the ultimate flight from collapsing fiat currencies. Quality stocks. Don't sell everything. Focus on quality. Companies with strong balance sheets, high profit margins, low debt, and essential products. Utilities, defense, medical supplies. These are the survivors that will buy up the assets of the zombies cheaply. The pattern is clear. The cycles are converging. The zombie junk debt bomb is ready to detonate. You cannot stop the winter, but you can prepare your shelter. Those who fail to see the pattern will be purged by the cycle. Those who position with liquidity and non-paper assets will emerge from the chaos to buy the future. The choice is no longer theoretical. The clock is ticking toward 2026.